right. Securities and investment advisory services offered through Next Financial Group, Inc., member FINRA and SIPC. Texas Hill Country Advisors is not an affiliate of Next Financial Group. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Past performance does not guarantee future performance. All the views expressed are those of Andrew Gay and Gilbert Paiz and Texas Hill Country Advisors and not those of Next Financial Group. The S&P 500 is a market cap weighted index composed of the common stocks of the 500 leading companies and leading industries of the U.S. economy, and the Dow Jones Industrial Average is a price-weighted index of 30 actively traded blue-chip stocks. All right, we are live. Welcome to the Texas Hill Country Advisors podcast, where we discuss financial education, stock market, and the economy, and how they may apply to you. And this is episode 1. My name is Andrew Gay. I'm an investment advisor representative with Texas Hill Country Advisors, and this is my business partner, Gilbert Paiz.
Hello.
Yes, hello indeed. We're really excited to be here. We hope you guys, we hope to be able to provide some value for you guys with this podcast. This is a long time in the making, so we're really excited to be here and be able to do this. So Gilbert and I are going to kick this off with a little market sum of what's happened in the markets in the last week. And then we're going to move right into our term of the day. And today we are talking about inflation. So without further ado, let's jump right to it. Gilbert, you ready?
Yes, sir. Absolutely.
All right. Okay, so we're still in earnings mode from last week, coming off a larger than expected jobs number last Friday, and the markets, all three indexes, the Dow, S&P, and NASDAQ, closed at record highs. The S&P posting its fifth and consecutive weekly rally, and the inflation debate continues, as well as supply chain snares. The 10-year U.S. government Treasury bond closed down at 1.453% last Friday. Bond market is closed this coming Thursday in observance of Veterans Day. Oil remains above $80 a barrel, and OPEC Plus declined the Biden administration plea to boost crude supplies over the weekend. Things we're looking out for this week: CPI number is coming out, which is the Consumer Price Index number, is coming out Wednesday morning, as well as all eyes being on the House infrastructure bill that was passed last Friday.
Hey, Andrew, you want to guess what the CPI number is going to look like?
Off the record only.
No. Well, I don't think it's hard to guess that it's probably going to be high.
Yeah?
I won't pin you down on an exact number, but pretty sure it's going to be high.
I heard like a 5-ish.
I don't know what it's going to be, but I don't think any of us has to look real hard to see what inflation is doing to everybody.
Yeah, and that's a good point, Gilbert. Thank you for mentioning that. We're going to get into that today. Since today's term of the day is inflation, we're going to jump right to it. So what we're going to do is take this term of the day, break it down, start super basic, give you guys a definition of inflation, kind of outline what it is, how it applies in our daily lives, and hopefully answer some questions that seem to be common questions about inflation in general. So what we're going to do, we're going to start off with a definition. This is from Investopedia.com. If you don't know what Investopedia.com is, you should really check it out. It's a really great resource, very vast amount of information on there, and it covers the full spectrum. So everything from basic definitions of financial terms and personal financial terms and what they mean, all the way to extremely complex concepts that are outlined on there. So it's an awesome resource. I use it very, very frequently. So per Investopedia.com, inflation is the decline of purchasing power of a given currency over time. Specifically for us, that would be the U.S. dollar, considering we all live in the U.S., or at least most of us, I think, that are listening to this do. This is a quantitative estimate of the rate at which the decline in purchasing power occurs can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over some period of time. The rise in the general level of prices, often expressed as a percentage, means that a unit of currency effectively buys less than it did in prior periods.
Yeah, I think the key phrase there is higher prices.
I know.
And I don't think any of us have to look real hard to see the effect of inflation on our purchasing power. Everything costs more, gasoline, groceries. My wife always complains about the high price of bacon, and eggs, and milk. And she drives a big car, a Suburban, so every time she fills it up, it used to take $50 to fill it up, and now it's bumping up against, $80, $90, and that's a problem. That's inflation for you.
Right. Yeah, and it's funny, that was like 5 sentences, and I think, it takes 3 words to basically get the gist across what we're talking about. So prices go up over time is the gist of inflation, right? So you mentioned a few things right there, Gilbert, so let's jump into that just a little bit deeper and peel back some layers. So the first question in general about inflation, and we get this a lot, is how does this tie back to my personal life? So how does what we're talking about, this financial concept of inflation, affect me on a day-to-day basis? You mentioned a few things, maybe the gasoline, grocery store. I know that's a big one, but you want to expand on any of that?
Yeah, I don't think it's real hard for us to figure out how it affects us on a personal level, like higher prices for commodities that we buy. But people have to understand that inflation will affect all of us, but not only individuals, but it also affects companies and businesses. When they buy products to sell to you, it's costing them more money. So every ingredient out there has to be trucked or shipped to a business. And so, every business is going to have higher costs too. And guess what? They pass those on to the consumer. So anytime you buy anything, it's going to cost you more. About the only way it's not costing you more is if maybe you grow your own vegetables and maybe have your own animals to sacrifice for food. But generally speaking, it's going to cost everybody more. And that's not just on an individual basis, but on a company-wide basis. So anytime you buy any products, it's going to cost more.
Yeah, so what you're saying is that, because when I was younger, before my financial days, I used to maybe think that companies just decided to jack up the prices because they could get away with it, right? So what you're saying is there's actual logic or numbers behind what's going on, right?
Absolutely, and we're not only talking about just the products that they're using to make and sell. They're also talking about labor. Labor, of course, is one of those things that adds to inflation. The cost of paying somebody to make that burger or deliver those groceries or make that rocket, it all costs more. And because these businesses have to pay more, they're going to pass those costs on to the consumers.
Yes, touche. Well said. I think, so I think a lot of us can feel it on a day-to-day basis. And maybe, and that's the other tricky thing too is, I might not actually feel it on a day-to-day basis, right? If the grocery store prices are going up, I might not notice it on a day-to-day basis, but maybe over a few months or a year or two, I definitely could, right?
Sure. And the interesting thing, Andrew, is that a little bit of inflation is good. You want to have a general increase in prices, but you just don't want it to get out of hand. There's many periods in history where inflation was out of control, and even now there's some countries in the developing world that are experiencing that. Venezuela comes to mind. They have skyrocketing inflation. Nobody can really afford to live in that country because every day that goes by, goods that they were buying the day before cost more. And so you have runaway inflation in a country like that, and in periods in the past where they've had runaway inflation, where you have countries that have that problem, it leads to instability. And so having uncontrolled inflation is a serious problem for most governments and most economies.
Right. Right. Yeah. And then, I don't think any of us really want to know what happens at the ground level when the economy's suffering like that, right?
Right, right. Well, and as I say, with inflation, a little bit of inflation is good because the opposite of that is deflation, and that creates its own problems. And so a little bit of inflation is good. You just don't want to have it uncontrolled. And the net effect of higher inflation is usually higher interest rates. And so that too is an interesting side note to the discussion about inflation. Interest rates is typically the tool that the government uses to control inflation.
Right, right. And actually, and we talked about that when we were on the lead previously.
Yes.
And last week with Lewis, we discussed a little bit about that. But that's where I think a lot of us can really feel it too, because how does that look at the ground level for someone in their day-to-day life? That one, it's safe to say I would feel if you carry any kind of like variable interest debt, right, and the interest rates go up because of inflation, you're going to see that. You're going to see that, possibly within like 1 month's time, right, on your credit card statement if you're
Absolutely
carrying a balance there. And I think I even mentioned like refinancing a house, right? So
Sure.
When you lock in fixed rates, that rate is based on the market interest rate. And if rates are going up, especially for some kind of note that you carry for 30 years, let's say, those little bitty points in interest make a difference. So
Absolutely they do. Yeah, the interesting thing is that inflation being an issue, the Feds are going to have to raise interest rates. We know that. The question is, when are they going to do it and by how much? And there again, too, rising interest rates is a good problem. It tends to be a good problem because it allows people that are savers to earn more interest on their savings. But earning more interest on your savings through higher interest rates is a double-edged sword because you're going to eventually see higher interest rates affect the economy too. And there again, you want to make sure that if interest rates are going up, that your portfolio, if you have one, and all your other assets that you have are positioned to protect yourself against that, because rising interest rates have their own issues. In fact, if you look at history, there are several investments that we recommend, or the financial world recommends, as a hedge against rising interest rates. For example, real estate, financials, energy companies, those are all good hedges against rising interest rates. And believe it or not, this year, the top three sectors are real estate, financials, and energy. I don't think any of us have a problem seeing how energy prices are much higher than they used to be, like we talked about, inflation. Energy companies have done really well. If you invest in energy companies right now, that might be a good hedge. Financials, if interest rates are going up, financials are usually a good place to be. And real estate. Real estate tends to be a pretty well-performing asset in times of inflation. So those are three things that you could look at as a hedge.
yeah. So you're saying there are options out there that
Absolutely.
could help an investor possibly mitigate some of the risk of inflation,
Sure.
right?
Sure, absolutely. Yeah. The risk of inflation and, of course, higher interest rates.
Yeah. Yeah, one of the things that we discussed in the budgeting class, plugged our financial literacy classes that we've been doing, was talking about budgeting for a fixed income. So I can only imagine if, let's say I'm on a fixed income and, we're dealing with some serious inflation. That can get kind of sticky pretty quickly, right?
Yeah, if you're living on a fixed income and inflation is taking more and more of your money, that's a serious problem. So you end up having to look either for alternatives, how can you increase your income, or you end up cutting back on maybe some of your essentials, and that's an issue for people that live on fixed incomes.
Sure. Well, so let's talk a little bit about how we already kind of touched on this with some of the explanations you've been giving, but how would I be affected possibly from portfolio standpoint. So if I have a retirement or non-retirement portfolio, how are some of the ways that inflation could affect my portfolio as an investor?
Sure. Well, I think generally speaking, higher interest rates are not necessarily a problem. The question then becomes, how soon do they get raised and by how much? So there again, too, gradually rising interest rates are okay. It takes time for the market to adjust, but typically rising interest rates are a good thing for the economy and the market in general, because rising interest rates means that there's growth in the economy. Inflation generally means there's growth in the economy.
Right.
And the feds are going to raise rates to keep a lid on inflation. So rising interest rates and inflation are usually okay. It's just you want it to be gradual and you want to give the market time to adjust. If interest rates go up quicker than we expect, or inflation's a lot higher than we expect, and the feds are forced to react quicker than we expect, that could be a problem.
Right.
Initially, rising interest rates tend to not be a good thing for the market, but over time it is. Just like when interest rates go down, that usually means the market goes up. Most of the time that's because when interest rates are going down, people have a tough time making money in savings accounts or very conservative investments, so they're pushed towards more aggressive investments like the stock market, the bond market, other assets that will make them more money.
Well, because that's pretty prevalent right now. Any of you guys out there, if you're watching this, you walk into a bank and ask for their CDs and savings rates. There's not a whole lot of meat on the bone, right?
Yeah. The best rate I was able to find for somebody last week for 1 year was 0.10, which is pretty horrible. And
not 1.0, 0.10.
1/10 of 1%. And I remember back in 2006, 2007, we could get you 5% for a year. I remember that. And those of us that are older than 50, that maybe grew up in the late 60s, early 70s, they could tell you a time when interest rates were above 18%. I don't remember that. I was a little kid back then, but that's one of the biggest comments I get from people about interest rates. Well, I remember back when I was younger that you could get 18%.
That you shared with me that Wall Street Journal article that talked about there was a fund company that was offering something like 14% tax-free back in the early 80s. I mean, it's just to someone like me that's only been in the industry, a decade, a better part of a decade. That's wild, man. That's wild.
Yes.
Yeah. So, and one of the points I heard that you kind of made was that, okay, so inflation can do its thing, but there's more factors than just, inflation itself. In particular, the rate at which inflation is happening, right? That could be just as much of a driver, or just as impactful as the actual inflation number itself.
Right. Absolutely.
Yeah. Good deal. So we kind of covered some of the pros and cons. We kind of bounced back and forth about some of that. But do you think, well, actually, you mentioned something that's interesting I wanted to ask you about. We don't have to go too deep into this, but in general, like what causes inflation? And from my understanding, I think there's more than one school of thought about this, right? And also to conclude from that therefore a lot of those are theories. So I'm not sure that any of them are the right answer, right? But the overarching theories that I found were either cost pushed or demand pulled inflation, right?
Well, sure. There's a lot of technical terms that are used to analyze that, but you can talk about the history of wages and whether or not real wages have risen over the past 20 years. There's plenty of evidence out there that would tell you that the reason inflation hasn't been a big deal for the past 15 or 20 years is because wages haven't really risen on a real basis. I don't know if that's true. There's a lot of information that would tell you right now the reason for inflation is the supply chain bottlenecks that we've got right now, and there's other people that would tell you that inflation's going crazy because of all the stimulus that's out there. I think the real answer is probably it's all of those things put together. All of those things put together is probably what's causing the inflation that we're seeing right now. But I'm pretty sure that the Feds are going to do their best that they can to keep a lid on it. Because as I said earlier, you don't want inflation to go out of control because it creates a whole bunch of problems. Namely, for example, let's just say inflation keeps going up at a very high pace, more than what the Fed is anticipating.
Right.
But guess what? They've already announced a schedule for when they're going to start reducing the stimulus that they've been putting to the economy. And if you were with us on the lead a couple of weeks ago, we had a little discussion about tapering. Tapering is the Fed's process for reducing the stimulus that they're putting out in the economy right now. But if inflation continues, there's a lot of people in the Fed that would tell you that inflation is transitory or temporary.
The T word, yes.
Yeah. That's interesting because you could say transitory or temporary, but every time you go fill up at the gas station, it doesn't feel transitory and it doesn't feel temporary.
That's right.
So there's a lot of things that point to inflation that's permanent, if you will. Now, let's say, for example, that inflation does increase, like we talked about. The Feds are going to raise interest rates. We know that. That's the tool that they use to keep a lid on inflation.
And just so we're clear, when we say the Feds, what we're talking about is the Federal Reserve Bank of the United States.
Yes, that's
Mr.
right.
J. Powell, Jerome Powell.
Central Bank of the United States government. Now, if they raise interest rates quicker than we anticipate, quicker than the market is anticipating, that could cause some pretty big gyrations, also known as volatility, in the market, because the market takes what the Fed says and prices in what they think is going to happen over the next 6 to 12 months. And so if they have to raise rates sooner than they expect, if they have to reduce stimulus sooner than they expect, well, the market's going to respond to that. And well, it's real simple what's going to happen. If rates go up real fast, the stock market's going to drop off, and the bond market will have some serious problems too, because they haven't had time to price those things in. So that's just an example. And I guess a case could be made for the exact opposite.
Right.
If inflation does turn out to be temporary or transitory, and the Feds find that inflation starts to reduce over time, that might even be good for the market.
Sure.
For the time being, because that means that the Feds are going to continue doing what they're doing and at the pace and a level that the market is expecting.
Right. Well, and it can be tricky too, because when we're talking about the market, we're not, there's the stock market is what most people think about, right? But there's also the bond market too,
which is about 4 times as big as the stock market. Most people don't realize that, but it's much larger than the stock market.
Yes, but it can be tricky because the market it anticipates what's going to happen, right? So sometimes both of us have seen over the years where things happen, news comes out, and the market seems to either overreact or underreact. Well, some of that could be because it already has priced in whatever that is, right? Because the market buys stories, right? So, that's one thing. The reaction to the market can be different, right? Is what you're saying.
Absolutely, yes. And the market can respond, even though the market is a predictive mechanism for the future. The market doesn't exist in a vacuum. So today's headlines can cause the market to drop off or jump up. But when you look at it over time, the market usually is responding
Right.
to these broader stories about inflation or interest rates or the general outlook for the economy. And because interest rates and inflation can affect that, you're going to see these responses to the market. And so the market isn't perfect. It's not a perfectly predictive mechanism, but
Right.
it's the best thing we got to use to predict what's going to happen with the economy over the next 6 to 12 months.
Yeah. Thank you for explaining that.
You're welcome. Hopefully, that's a primer that everybody needs on inflation and interest rates.
Right.
We probably need to have a show about just interest rates.
Yeah, and and that's the other thing with us doing this podcast that Gilbert and I have discussed is in our world where we exist, in the financial world, there is the amount of detail and the level of complexity that rabbit hole goes so deep that sometimes the challenge for our jobs is literally just how to articulate or explain things to people where they can understand it. And that's part of what we're attempting to do on the show too. So this was our first run at this. We hope that you guys found some kind of value in it. We hope that we taught you some kind of lesson. Be looking for some of these in the future too. So we're really excited to do this, and we also seek plenty of feedback. So after this is all said and done, if you guys want to shoot us some questions or maybe topic suggestions, for future videos, future podcasts, we would love it.
Yes.
Yeah.
What we hope to do, I think it's fair to say, and is provide information so that you can make an educated decision. And one of the things that we'd like to talk about, and eventually we hope to bring on guests to talk about some of these subjects too. We want to help you understand the market, the economy, and how it affects you, and what you can do to mitigate some of the craziness that's out there. Because a lot of times when you don't have information, you make decisions that are based on incomplete information, and you end up shortchanging yourself. And what we'd like to do is just provide information and be a resource for people to come to and say, hey, listen, I heard you talking about this on the podcast the other day. Here's my situation. What do you think? Could you give me some ideas? And maybe we don't have a perfect answer for you. Maybe we don't have the right solution for you. But maybe we can point you in the right direction and say, listen, that's not that's not something I can help you with, but here's a guy that I know that can help you, and maybe we can refer you to somebody that can help you. We like to think that we're financial doctors, and financial doctors have specialties, and what we tend to be is more like family practice doctors, I guess you could say. We're general practitioners, I guess you could say, and sometimes you need a specialist, and if you need a specialist, we can point you in that right direction, and sometimes that's all people need. Just where should I go to for this question? The good thing about being in the local community is we know a lot of people, a lot of other professionals that can help you answer questions that maybe we're not exactly geared up to answer, especially if you have something complex like estate planning needs or tax questions. Those are things that we can't give you advice about,
right.
But we know plenty of people in town that can help you with those things. So,
that we do.
We're certainly going to do our best to listen to your question, ask questions, and then if we can help you, we will. If we can't, we'll refer you on, but at least you got the information. So don't ever hesitate to give us a call, stop by our office, come and see us. Hopefully you'll be seeing this on our Facebook page and YouTube channel. We have a website, TexasHillCountryAdvisors.com.
I believe it's right there behind us, too.
There we go.
Right?
Yes, TexasHillCountryAdvisors.com.
Fancy schmancy sign
You've
right there.
got our contact information on there, phone number, and of course we can give you our address if you want to come and visit with us in person. So anytime we can be a resource, please give us a call.
Well, I think we're winding down our time. We really hope that you guys found some value in some of the discussion that we had. Look for us in the future, and we're dead serious about send us some ideas. Feedback maybe about what we discussed here tonight. But anything that you guys got going on in your world that you want to know more about.
Absolutely.
So thank you guys so much. We'll see you again next time.